The world of investing is full of concepts and terminology that often confuse even the most experienced individuals. Among these ideas is the traditional division between growth stocks and value stocks, a dichotomy popularized by Wall Street, but one that, in practice, doesn't make sense. This text challenges that idea by asserting that the true essence of investing lies not in the simplistic categorization of assets, but in the ability to identify solid companies that can grow sustainably and generate consistent returns over time. Through historical examples and a critical analysis of financial fads, it becomes clear that success in the market depends more on discipline, deep knowledge, and patience than on strategies based on volatility or risky predictions. Throughout this reflection, we will see how logic and wisdom are the keys to achieving lasting results, while the obsession with market timing and magic formulas can lead to judgment errors and significant losses. We would never leave money idle just for the sake of leaving money idle. We would never think of establishing a fixed cash position, like X% of our portfolio. These asset allocation models that Wall Street strategists preach, 60% in stocks, 30% in bonds, are complete nonsense. We want all of our money working in good businesses. But sometimes we simply can't find good opportunities, or money comes in unexpectedly, or we sell an asset and end up with more cash than we would like. And when I say more cash than we would like, I'm talking about 10 or 15 cents per dollar, because we want our money invested. We never invest just to invest. If cash continues to accumulate aimlessly, we become extremely dissatisfied. One way or another, we will find a way to use it. It might sound unbelievable, but Charlie and I don't have an opinion about the market. And for a simple reason, it wouldn't make the slightest difference. If we find a good business, we ignore any market predictions. It would be stupid to avoid investing in something solid just because someone speculates that the market might fall. If we're sure about something profitable, why would we give that up in exchange for a guess? That makes no sense at all. The same applies to diversification. What is taught about diversification is, in most cases, a misconception. Excessive diversification is a protection against ignorance. If you don't know how to analyze businesses, the best way to protect yourself is to invest a little in everything, and there's nothing wrong with that. But if you know how to evaluate companies, over-diversifying is foolishness. There aren't 50, 40, or even 30 truly exceptional and understandable companies for a single investor. If you have an incredible business and put money into the 30th company on your list instead of reinforcing your best investment, that's pure insanity. Many teach that diversification is essential, but the truth is that great fortunes were not built with portfolios of 50 companies. They were made by people who found extraordinary businesses and bet on them. That's why I only own one stock, because I know the business inside out, and that makes me totally comfortable. The idea that someone needs 28 stocks to be diversified is absurd. 3 truly exceptional businesses are more than enough to prosper. And the problem goes further. A lot of what's taught in corporate finance courses is pure nonsense. Volatility doesn't measure risk, but academics don't know how to measure risk, so they adopted volatility as a benchmark. The problem? It's mathematically beautiful, but completely wrong. Volatility does not define the real risk of an investment. If that were the case, agricultural land in the U.S. interior, which had very low volatility over the years, would be a risk-free investment, which, of course, is not true. In the end, it all boils down to thinking, understanding businesses, and investing with conviction. The rest? Noise. In the early 1980s, farms that were being sold for $2,000 per acre plummeted to just $600 per acre. It was at this moment that I bought one of them, at the height of the banking and agricultural collapse. What did traditional market theory say? That the risk of these properties had skyrocketed. According to academics and their mathematical formulas, by buying the same farm for $600, I was taking more risk than if I had bought it for $2,000. This is a monumental absurdity. Since when does paying less for a productive asset increase the risk? That would be the same as saying that if a $500,000 house drops to $200,000, it becomes riskier just because its price dropped. It's a complete reversal of logic. If this were true, any farm in the world would become a gamble. But because land prices aren't quoted minute by minute, no one thinks this way. However, when we talk about stocks, logic is reversed, and somehow the price volatility becomes synonymous with risk. The truth is much simpler and more brutal. Risk comes from ignorance and the nature of the business, not from price fluctuations. Some sectors are inherently more risky, regardless of what the quote says. If you deeply understand the business you're investing in, know its fundamentals, and pay a fair price, then there's no real risk. At Berkshire, Charlie and I have never had a significant permanent loss in securities. Sure, we've made mistakes, like the disastrous purchase of Dexter Shoe, which was a judgment error about the business, not about the volatility of leather or the footwear market. But in tradable stocks, where we were supposedly supposed to fear volatility, our decisions have always been based on logic, not fear. The idea of measuring risk with volatility is completely useless to us. Great universities teach this nonsense in finance and investment management courses, and the worst part? Highly intelligent people believe it. Part of our success came from simply recognizing that very smart people do incredibly stupid things. If you really want to invest well, you should forget all the sophisticated mathematical models that try to measure risk as if it were a magical number or a ready-made equation. The financial market doesn't follow rigid, predictable rules like these algorithms try to suggest. It is unpredictable, full of nuances, and influenced by emotional, psychological, and above all, human factors. Investing well is not about using complex formulas to calculate a supposed risk. In reality, it's about thinking for yourself, being able to analyze a situation and make decisions based on logic and facts, not trends or attempts to predict the future. Investing well also has nothing to do with having a genius IQ or a superior mind, but rather with temperament and discipline. Self-discipline is infinitely more valuable than any brilliant intelligence when it comes to investments. The market does not reward those who follow the herd or try to guess the next stock movement based on predictions. The real key to success lies in being patient, rational, and disciplined. As the legendary investor Ben Graham said, "You're not right just because 1,000 people agree with you, nor wrong because 1,000 disagree. You're right when your logic and facts are sound and consistent." And what is the best investment anyone can make? The best investment you can make is investing in yourself. Investing in your own development and personal improvement is the only investment that will always bring returns. Skills like communication, negotiation, and leadership can increase your personal and professional value by at least 50%. Real knowledge can never be taken away from you. Unlike stocks, real estate, or even precious metals, what you learn and develop is always under your control and never loses its value. And this, indeed, is an advantage that no market can fluctuate. However, in the financial market, the situation is ironic. It is full of experts, financial gurus, and advisors who try to convince you that you need them to decide things as simple as the composition of your portfolio, whether it's 60-40 or 65-35. This is pure nonsense. These experts make a living by selling a mantle of sophistication and complexity to hide the simple truth. The secret to investing well is not in magic formulas or tricks, but in patience, rationality, and discipline. Investing wisely is an ongoing process of learning and reflection, where decisions are made based on logic, not on external pressures or market trends. And to make matters worse, there is a popular idea circulating in the industry that billionaires face big problems managing their fortunes. Recently, I read an article about the founders of Google facing difficulties because they are going to receive billions. I almost sent a sympathy card. In reality, the problem isn't theirs. The real problem is with the entire industry that relies on maintaining the illusion that these billionaires need help managing their wealth, because without this belief, financial advisors would be out of a job. This is yet another clear example of how the financial industry survives, selling illusions. They want you to believe you need them to know the exact percentage of stocks in your portfolio. But the truth is that you don't need magic formulas or financial advisors. The most important thing is to maintain a solid portfolio, based on companies you understand, with strong fundamentals that can generate value over time. This reminds me of an old saying from the cattle market, which goes, "It's not about how you sell, It's about how you tell the story. The financial industry is one of the best storytellers in the world, and as an investor, you need to be aware of this dynamic. In the end, the only one who needs to believe in these stories is you. So instead of following the advice of experts and advisors, focus on enhancing your own knowledge and critical thinking. That's what will truly help you succeed in the market. Therefore, when someone suggests that you should alternate between growth stocks and value stocks, that person simply doesn't understand what it means to invest intelligently. The real goal is not to choose between labels like growth stock or value stock, but rather to allocate capital strategically and intelligently to ensure you will get more capital in the future. If a company has a solid business model with well-structured fundamentals and sustainable growth, it will naturally create value and thrive over time. It doesn't matter whether the company is labeled as a growth stock or a value stock. What matters is the quality and durability of the business. What defines a great investment is not the title of growth stock or value stock, but rather the quality and durability of the company. A truly exceptional company is not one that will perform well for only 3 or 5 years, but one that will be able to maintain its excellence over 3 decades or more. Success in investing lies in betting on companies with solid fundamentals that can endure generations without losing their relevance or market position. The true test of time is when a company can adapt and grow sustainably, not because fashion or hype says it is hot, but because it has a real and lasting competitive advantage. Now imagine that you're going to embark on a 20-year journey around the world, with no access to your bank accounts, no contact with the financial market, no emails or daily news about what's happening in the market. Which companies would you trust to leave your money invested in without losing sleep, knowing that they will continue to grow and create value over time? If you feel you need to monitor an investment daily, it's a sign that perhaps the business is not as good as it seems at first glance. A great investment is one where you trust the quality of the company so much that, even without monitoring it constantly, you know it will remain solid and successful over the years. Many investors waste years trying to time the market, waiting for the next crisis or panic to buy shares of great companies at low prices. This strategy is akin to a funeral agent hoping for a flu epidemic. It may work once in a while, but in most cases you end up wasting a huge amount of time waiting for an opportunity that may never come. The real secret to success in investing is to find extraordinary companies and hold them for long periods, not trying to guess when the market will fall or when the next collapse will happen. Investing is about focusing on the long term, on quality, and on the ability to create sustainable value, not searching for shortcuts or opportunities that only exist in the imagination. During the last big crisis, many said that cash is king. This, in fact, is a complete absurdity. Money sitting in a bank account or a safe doesn't produce anything. It doesn't generate wealth. It doesn't generate returns. And its value loss over time due to inflation is practically guaranteed. Of course, it's essential to have a reserve for unexpected or emergency situations, but keeping an excessive amount of money saved while waiting for the perfect time to invest is as useless as storing excess oxygen when there's already enough to breathe. What happens is that by leaving money idle, you are missing the opportunity to turn it into something more, while it loses purchasing power every day. In the end, patience and rationality outweigh any complex strategy. The market is full of magic formulas and predictions about the future that often turn out to be ineffective or simply irrelevant. You don't need to follow the Wall Street gurus who always talk about economic cycles or imminent crises. What truly matters in investing is common sense, emotional discipline, and the ability to ignore market noise, which often tries to convince us to act impulsively. The message that emerges from this text is clear. True investment success lies in the simplicity of logic, in emotional discipline, and in depth of knowledge, not in the complications and excess models created by formulas or trends dominating the financial market. Too many investors get caught up in the complex world of jargon and competing strategies, endlessly trying to distinguish between growth stocks and value stocks, as if these were opposite categories. However, this is a false dichotomy that doesn't reflect how businesses actually function. Growth and value are intimately intertwined aspects. They are not mutually exclusive. In fact, they often complement each other, and a successful investment strategy incorporates both. The reality is that what truly matters is the quality of the investment itself and its capacity to generate sustainable and consistent returns over the long term, regardless of whether the stock is labeled as growth or value. Investing well is not about trying to time the market or predict crises, two pursuits that are notoriously unreliable and fraught with uncertainty. In fact, the notion of market timing is not only futile, but can be dangerous. Rather, successful investing revolves around identifying solid companies that possess the ability to endure decades while maintaining their relevance and strength. These businesses are the true safe havens for capital. Unlike speculative ventures, these companies offer investors the ability to weather economic storms with peace of mind. Investors can rest assured knowing their choices are based on the underlying sustainability, resilience, and high quality of the companies they have chosen. An important concept to grasp here is that volatility does not necessarily equal risk. This is a misunderstanding often perpetuated in the media and financial circles. The real risk in investing does not lie in momentary price fluctuations or short-term volatility. Instead, the true risk arises from ignorance about investment fundamentals and poor capital management. When investors make decisions based on emotional reactions or hearsay, they increase the risk of making mistakes that can harm their financial future. Understanding the fundamentals of the companies you invest in is what truly mitigates risk and leads to successful, long-term outcomes. Examples from various sectors like aviation, which has grown impressively over time, and companies like See's Candies, which understood how to balance growth with efficiency, clearly illustrate that growth is only valuable when it is efficient and financially sustainable. There's a critical distinction between real, healthy growth and growth that simply requires large investments that don't generate proportional returns. Growth that demands excessive capital input but results in minimal or diminishing returns is not growth at all. It is, in fact, mismanaged risk. True growth is about creating value that scales over time without over-leveraging or compromising the company's long-term stability. Additionally, this text emphasizes the importance of not following the herd or being swayed by the specialized voices of Wall Street. In the fast-paced and often chaotic world of finance, it can be incredibly tempting to follow the crowd, especially when the media and analysts are constantly making bold predictions and offering seemingly expert advice. However, many of these voices prioritize selling illusions or stirring fear, capitalizing on the emotions of investors rather than promoting solid and intelligent investment decisions. They rely on sensationalism to attract attention, often exaggerating the risks and rewards associated with specific stocks or sectors. Wall Street's obsession with short-term trends, constant market fluctuations, and looming crises often clouds the judgment of investors who fail to look beyond the surface and ask the critical questions that matter in the long run. These voices may make you feel insecure about your decisions, creating anxiety and doubt in your mind. You may find yourself questioning your investments, second-guessing your choices, or wondering if you're missing out on the latest opportunity. However, the most important thing is for you to seek clarity and self-sufficiency. It is crucial to build confidence in your own investment process and decisions. Trust in your own ability to invest, not based on rumors or the opinions of others, but based on your own knowledge and research. Relying on logical analysis grounded in real facts is the foundation for making wise investment choices. This requires you to take a step back from the noise and distraction, to examine each investment thoroughly, and to always align your decisions with your long-term goals and values. The ability to think critically and independently without being influenced by the noise around you is a key trait of successful investors. In fact, those who are able to ignore the constant chatter of market pundits and stick to a disciplined, well-thought-out strategy are the ones who ultimately thrive. The best investors are those who can filter out the daily distractions and focus on what truly matters: the long-term growth and sustainability of their investments. They recognize that investing is not about following the latest trend or chasing after quick wins, but about finding great companies and holding on to them through market ups and downs. Finally, the most powerful lesson in this text is that investing well is not about possessing superior intelligence or finding secret formulas. There is no magic trick, no algorithm that will guarantee success in the markets. The real edge in investing comes from understanding the importance of temperament and perspective. Investing is not a get-rich-quick endeavor. It is a long-term game, and the market rewards those who have patience, discipline, and a long-term vision. While it's tempting to chase after short-term profits or try to predict the next big move, the most successful investors are those who understand that true wealth is built over time. They have the patience to ride out market volatility, the discipline to stick to their strategies, and the vision to see the potential of their investments years down the road. The true edge in the world of investments lies in the ability to stay rational and focused on the essentials, especially when everyone around you is driven by emotion, volatility, and haste. In the midst of market crashes, economic downturns, or speculative bubbles, the successful investor is the one who remains calm, collected, and clear-headed. This is the core of investing, staying grounded and making decisions based on careful reasoning, not on fear or greed. Successful investing is not about acting impulsively when the market is down or rushing to sell when stocks are rising. Instead, it's about keeping a steady hand, staying true to your investment strategy, and ensuring that each decision aligns with your long-term goals. In the end, the difference between success and failure in the financial markets is rooted in your mindset. This, more than any formula or investment strategy, is what guarantees stability and success in the financial market. The markets will always fluctuate, and new trends will continue to emerge, but those who remain focused on the bigger picture and are guided by their own principles will consistently outperform those who act based on fear or hype. The investment world is full of noise, but those who maintain a clear, disciplined approach, who prioritize long-term value, and who are patient in their decision-making will always come out ahead in the end. The key takeaway is that investing is about playing the long game. Those who can look past the short-term volatility and focus on the fundamental value of their investments will not only build wealth, but also safeguard it. This principle, rooted in rational thinking, emotional discipline, and a clear sense of purpose, is the foundation of every great investment success story. In the end, the most important thing is to stay true to yourself, trust your process, and know that consistency and patience will reward you in ways that quick wins never will.